There is a specific kind of silence that descends on Wall Street on a Friday evening. Usually, it is the silence of relief. The trading week is over, the terminals are dark, the bankers go to their Hamptons houses to drink champagne. But this weekend, the silence is different. It is the silence of a bomb squad staring at a wire they just failed to cut. We just witnessed something that was not supposed to happen. According to the script that has run for 40 years, silver was supposed to crash on Friday. They tried to smash it at $65. They tried to smash it at $66, but the market didn't just hold, it accelerated. The closing price on the screen is $67.14. Let that number sink in. $67.14. We didn't just break the resistance, we blew the roof off the building. We closed at the absolute highs of the week. For the retail investor, this is a moment of celebration. But inside the risk management departments of the major bullion banks, this is a nightmare scenario. Why? Because markets are closed. They are stuck. They are holding billions of dollars in short positions that are now deeply underwater. And they have to sit there for 48 hours unable to trade, unable to hedge, and unable to stop the bleeding. In this urgent market update, we are going to take you inside that nightmare. We are going to explain what a weekend margin call looks like. We are going to analyze why this specific closing price changes the mathematics of the entire silver market. And we are going to talk about Monday morning, because when a market closes at the highs on a Friday, it rarely opens quietly on a Monday. The panic is building behind closed doors. And when the doors open, the stampede begins. This is the story of the weekend the banks lost control. To understand the magnitude of 67s, you have to understand the Friday script. For decades, silver investors have suffered from Friday fatigue. We would have a great week. The price would rally. Everyone would get excited. And then at 10:00 a.m., New York time on Friday, wham, a massive sell order would hit the futures market. The price would drop $2. We would close the week weak. It was designed to ruin your weekend. It was designed to make you feel like a loser for holding. We saw them try it again this week. We saw the dip. We saw the attempt to pin the price below $65. This time, the buyers didn't blink. Instead of selling into the close, the buyers aggressed. They bought the offer, they cleared the book, they pushed the price up right until the final bell rang. This is a change of character. It tells us that the suppression algorithm is broken. The banks fired their ammunition and they ran out of bullets before the market ran out of money. When you see a market close on its highs, it means one thing: fear, not fear of a crash, fear of not owning enough. The buyers were so desperate to get in that they didn't care about the price. They just wanted to be positioned before the weekend. They know what is coming next week, and they didn't want to be left behind. Now put yourself in the shoes of a commercial short seller. You are a bank. You sold silver at $64, promising to deliver it later. You expected the price to drop so you could buy it back at $60, but the price is $67.14. You were losing more than $3 an ounce on millions of ounces. When the market is closed, you are in prison. You cannot exit your trade. You have to watch the news all weekend. You have to watch the geopolitical tensions rise. You have to watch the articles about Samsung batteries and solar shortages go viral. And every piece of news makes you sweat because you know that when the Asian markets open on Sunday night, everyone else reads that news too. If Asia gaps the price to $68, your loss gets bigger. This creates a psychological pressure cooker. The risk managers at the banks are currently running stress tests. They're asking, what happens if silver opens at $70? Can we survive? If the answer is no, then they have only one choice. They have to issue a market on open buy order. They have to tell their traders, I don't care what the price is on Sunday. Buy it all. This is how you get a gap and go. The pent-up panic from the weekend releases all at once in the first minute of trading. We are set up for one of the most violent opens in history. Why is 67.14 such a critical number? Technically speaking, it clears the noise. Between $60 and $65, there was a lot of chopping. But above $67, the air is thin. If you look at the monthly charts going back 40 years, there's almost no trading history at these levels. We are in blue sky territory. There are no bag holders from the past waiting to sell to get their money back. Everyone who holds silver right now is in profit, and people in profit don't panic sell. They hold. They wait for more. This removes the overhead resistance. The only resistance left is psychological. $70, $75, these are just round numbers in our heads. They are not structural walls. So 67.14 is the signal that we have left the battle zone and entered the discovery zone. In the discovery zone, price moves fast. It seeks a new equilibrium. And since we know there is a physical shortage, that equilibrium is much, much higher. However, I must be the voice of reason here. I know you're excited. I am excited. But we must be careful. When a market goes vertical, when it closes at the absolute highs, it attracts tourists. It attracts gamblers who use massive leverage because they think it can only go up. These gamblers are dangerous. They put their stop losses very close to the price. If the banks manage to engineer a $2 drop on Monday, all those gamblers will get washed out. Their selling will accelerate the drop. So while 67.14 is incredibly bullish, it also increases the risk of a shakeout. The higher we go in a straight line, the more violent the correction will be when it comes, and it will come. Nothing goes up in a straight line forever. We might see a retest of $65. We might see a scary morning where silver drops $3. You need to be prepared for this. Do not look at 67.14 and think, it is easy from here. It gets harder. The volatility will try to buck you off. But understand this distinction. A correction is healthy. A crash is a change in trend. Given the shortages we have discussed, the Samsung battery demand, the recycling limits, the empty vaults, a crash is unlikely. Any drop is just the market checking to see if you are serious. So the price is high, the shorts are trapped. But what are the banks actually doing right now? It is the weekend. The markets are closed, but the lights in the skyscrapers are on. In part 2, we are going to look at the weekend margin call. I'm going to explain exactly what happens inside a prime brokerage when a client blows up. We are going to discuss the possibility that a smaller fund or bullion dealer might default. And we are going to talk about the physical run. With the price this high, people aren't selling silver. They are rushing to buy it before it hits 100. We will look at the supply chain collapse that is happening in real time. The price is the signal. The panic is the reality. Stay tuned for part 2. We are going inside the risk room. If you are just joining us, let's reset the scene. It is Saturday, December 20th. The markets are closed. The price of silver is frozen on the screens at $67. To the outside observer, the financial world is asleep. But inside the glass towers of Manhattan and London, the lights are burning bright. In part 1, we talked about the broken script. Now, we need to go deeper. We need to walk into the risk room. Every major bank has a risk department. Their job is to make sure the bank doesn't blow up. Right now, those risk managers are looking at a spreadsheet that is bleeding red ink. They are looking at the short exposure of their clients who bet against silver. And they are realizing that many of those clients are insolvent. In part 2, we are going to explain the mechanics of the weekend margin call. We are going to show you why phone calls are being made right now that will force billions of dollars of buying on Monday morning. We are going to look at the physical freeze where bullion dealers stop selling because they cannot afford to restock. And we are going to expose the unallocated bluff that is being called by the world's wealthiest investors. The price is high, but the panic is higher. Let's go inside. Most people think margin calls happen instantly. A computer flashes red and the position is closed. That is true for retail traders, but for institutional money, the big whales who trade billions, it works differently. They operate on variation margin. At the end of every day, the exchange calculates who won and who lost. The losers have to wire cash to the exchange to cover the difference. Usually this is routine. A few $1 million here and there, but Friday was not routine. The move to 67.14 was violent. It caught the shorts completely off guard. Many of these funds were betting on a pullback. They were leveraged to the hilt. When the bell rang on Friday, they were staring at losses that exceeded their cash on hand. So, what happens on Saturday morning? The prime broker calls the hedge fund manager. The conversation goes like this. You're down $500 million. You have exceeded your credit limit. We need you to wire $300 million by $800 a.m. Monday morning. The fund manager says, I can't. The banks are closed. I have to sell other assets first. The prime broker says, if the wire is not there by 8:01 a.m., we will liquidate your position. This is the forced liquidation. It doesn't matter if the fund manager thinks silver will go down next week. It doesn't matter what his thesis is. He has no cash. The bank takes control of the account, and the bank's computer has only one instruction: close the position. Since they are short, closing the position means buying. Buying at any price. Buying until the risk is zero. This is what creates a gap up on Monday. It isn't people rushing to buy because they love silver. It is banks rushing to buy because they are terrified of their own clients defaulting. We are looking at a potential cascade of defaults on Monday morning. If the price gaps up to $68, the next tier of funds gets the call. It is a domino effect, and the first domino just tipped over. Now, let's leave Wall Street and look at the physical market. The online bullion dealers, the local coin shops, the wholesalers, they are in a state of shock. Imagine you are a coin dealer. On Friday morning, when silver was lower, you sold 1,000 ounces for $64. You took their cash. You promised to ship the coins. You expected to call your wholesaler on Monday and buy those coins for $63. But now the price is $67.14 and the premiums are rising. To replace the coins you just sold, you might have to pay $70. You just lost $6 an ounce on a 100 ounces. You are bleeding capital. This is called replacement cost risk. In a violent bull market, selling inventory is dangerous. If you sell your stock and the price jumps before you can restock, you go out of business. You sold gold to buy paper, and the paper lost value. So what do dealers do on a weekend like this? They freeze. Go to the websites right now, look closely. You will see one of three things. Sold out banners on everything. They are hiding inventory. Maintenance mode screens. They shut down the site to stop the bleeding. Or massive premiums. They jacked up the price to $80 to discourage buying. They are trying to stop the bleeding. They are waiting for Monday to see if the price is real. This creates a physical vacuum. The demand from the public is exploding because of the price rise, but the supply has vanished because the sellers are terrified. This is the perfect storm for a price squeeze. Buyers with cash, sellers in hiding. The only way to bring the sellers back is to bid the price much, much higher. There is a bigger game being played at the very top of the wealth pyramid, the unallocated accounts. We touched on this before, but this weekend it is critical. Banks hold billions of ounces of silver on behalf of wealthy clients. Most of this is unallocated. It is a claim on the bank's pool of metal. The bank uses that pool to lease, to industry, to hedge, to trade. They run a fractional reserve. But when the price hits $67 and when rumors of shortages start flying, the wealthy clients get nervous. They ask the question, does the bank actually have my silver? This weekend, we are hearing reports of a quiet bank run on the vaults. Family offices are sending instructions to convert their unallocated holdings to allocated. Put my name on the bar, move it to a segregated shelf, send me the serial numbers. This forces the bank to show its hand. If they have the silver, fine, they move it. But if they don't, if they leased it to Samsung or sold it to China, they have to go into the market and buy it immediately to satisfy the client. They cannot tell a billionaire, we don't have it. That triggers a lawsuit and a collapse of confidence. So they quietly pay whatever it takes to get the bars. They pay $68, they pay $70. This internal squeeze is invisible to the retail trader, but it is the driving force behind the resilience of the price. The banks are bidding against each other to secure the metal they owe to their own clients. They are trapped in a web of their own rehypothecation. So what happens when the bell rings on Sunday night? We have hedge funds facing margin calls, dealers desperate to restock, banks covering unallocated deficits. Who is selling? Nobody. Who wants to sell at $67 when it looks like it is going to 100? The miners aren't selling, the stackers aren't selling. This imbalance, massive forced buying versus zero selling, creates a gap. The price teleports. It might close Friday at 67.14 and open Sunday at 68.50. It skips the prices in between. This is the nightmare for the shorts. They don't even get a chance to cover at 67.50. They get filled at 69. Their loss expands instantly. If we see a gap up on Sunday night, it confirms that the weekend margin call was real. It confirms that the panic is systemic, and it sets the stage for a run to $72 by Tuesday. The banks are panic buying. The dealers are hiding. But what about the metal itself? Where is it going? In part 3, we are going to look at the physical flows. We are going to track the movement of silver from west to east. We are going to look at the arbitrage that is draining the COMEX and filling the vaults of Shanghai. And we are going to explain why the spot price you see on your screen is becoming a fiction. The paper market is a casino. The physical market is a battlefield. And right now, the battlefield is being stripped bare. Stay tuned for part 3. We are going to follow the metal. If you are just joining us, we have covered the financial panic. We have looked at the banks staring at a $67 price on a Saturday, realizing they are trapped. We have looked at the margin calls going out to hedge funds, but finance is just numbers on a screen. Silver is real. It has weight. It takes up space. And right now, while the paper markets are closed for the weekend, the physical metal is moving. It is moving on ships. It is moving on planes. It is moving in armored trucks. And it is all moving in one direction, east. In part 3, we are going to expose the physical vacuum. We are going to look at why the warehouses in London and New York are being drained to feed the insatiable appetite of Shanghai. We are going to explain why the spot price you see on your phone is becoming a ghost number. And we are going to look at the industrial horde that is bypassing the public markets entirely. The banks are fighting over paper contracts. The world powers are fighting over the atoms. Let's follow the metal. To understand why the West is running out of silver, you have to look at the price difference between New York and Shanghai. This is called the arbitrage spread. Right now, the COMEX in New York closed at 67.14, but the Shanghai Gold Exchange is trading significantly higher due to the solar demand and the battery panic. Silver in China is trading closer to $72. This is a $5 gap. In the world of commodities, a $5 gap is a black hole. It has infinite gravity. If you are a global refiner, where do you send your silver? Do you send it to New York to sell for $67? Or do you send it to Shanghai to sell for $72? You send it to Shanghai. Every single bar that isn't nailed down is being put on a pallet and flown to China. This creates a supply shock in the West. The metal that usually replenishes the COMEX vaults is being diverted. The metal that usually sits in London is being withdrawn. This is the Shanghai magnet. It is sucking the liquidity out of the Western financial system. And because the markets are closed this weekend, the spread might widen even further before New York opens. While New York sleeps, the metal leaves. And when New York wakes up, the cupboard will be bare. There's another drain on the supply that you will never see on a chart. Direct procurement. In a normal market, companies like Samsung or Tesla might buy silver futures to hedge their costs. But in a shortage, futures are useless. You can't build a car with a paper contract. You need the metal in your factory. So what are these giants doing this weekend? They are doing off-market deals. They are calling the mining companies directly. We will buy your entire production for the next 2 years. We will pay you $70 an ounce, and we will pick it up at the mine gate. This is catastrophic for the COMEX. The COMEX relies on the excess silver from miners flowing into its vaults to back the contracts. But if Tesla buys the silver before it even leaves the ground, that silver never reaches the COMEX. It disappears from the public ledger. We are seeing a bifurcation of the market. There is the public market where crumbs are traded back and forth by speculators, and there is the private market where massive tonnage is being locked up by strategic industries. The public market thinks there is plenty of silver. The private market knows there is none. This weekend, the private market is busy securing the last remaining stockpiles. By Monday morning, the available inventory will be lower than it was on Friday. This leads us to a controversial truth. The spot price is broken. For 40 years, we accepted that the price discovered on the futures exchange was the real price. But that mechanism assumes that you can easily turn paper into metal. That assumption is failing. If you go to a dealer today, or even a wholesale distributor, and you say, I want to buy silver at the spot price of $67.14, they will laugh at you. They will say, good luck, our price is $78. The spot price has become a reference rate for paper gambling, not a purchase price for physical goods. This divergence is the death knell of a currency system. We saw it in the Soviet Union. The official rate for bread was low, but there was no bread. The black market rate was high, and you could actually eat. We are entering a phase where the physical premium is permanent. It isn't a temporary surcharge. It is the real price asserting itself. So when you look at $67.14, do not think that is the value of my stack. Think that is the lie they are telling to keep the system calm. Your stack is worth what someone will pay for it. And right now, desperate industries are willing to pay much, much more than the screen says. Finally, let's look at the registered category in the COMEX vaults. This is the metal that is legally available to settle contracts. For years, this number has been dropping from 150 million ounces to 80 million to 30 million. With the price at $67, we are entering the danger zone. For a delivery default, the shorts who are trapped have two choices. Pay billions in cash to close the position or deliver the physical metal. They would love to deliver the metal. It is cheaper than buying back the contract at a loss, but they don't have the metal and they can't get it from London because Shanghai took it, and they can't get it from the miners because Samsung took it. So they are forced to raid the COMEX registered inventory. We are watching the eligible private pile stay flat, while the registered public pile evaporates. If registered hits zero or gets close enough to zero to cause panic, the exchange breaks. They have to declare force majeure and settle in cash. This weekend, traders are doing the math. They're calculating the cover. Ratio. How many paper claims exist for every physical ounce at $67? That ratio is exploding. The higher the price goes, the more people want delivery. The more people want delivery, the faster the vault drains. The faster the vault drains, the higher the price goes. It is a feedback loop that ends with the destruction of the paper market. So the physical metal is fleeing to the east. The industry is buying direct. The spot price is a fiction. And the banks are staring at a massive gap up on Sunday night. What do? How do you trade this open? Do you buy the gap? Do you sell the rip? Do you sit on your hands? In part 4, the conclusion of this weekend update, I am going to give you the Monday battle plan. I'm going to show you the specific price levels to watch in the first hour of trading. I'm going to explain the psychology of the gap, why buying a gap up feels scary but is often profitable. And I am going to leave you with the final verdict on where this weekly candle points us. The nightmare is real for the banks. The opportunity is real for you. Stay tuned for part 4. We are preparing for the open. We have reached the final chapter of this weekend market alert. We have dissected the Friday close at $67.14. We have exposed the panic inside the bank risk rooms. We have tracked the physical metal fleeing to Shanghai. Now we are left with the silence of Saturday. But this silence is deceptive. It is the deep breath before the plunge. In less than 36 hours, the Asian markets will open for the new week. And the banks, the hedge funds, and the industrial buyers will all rush through the same door at the same time. In this final breakdown, part 4, I'm going to give you the Monday battle plan. I'm going to teach you how to handle a gap up, because if silver opens at $69, your instinct will be to panic buy. That might be a mistake. I'm going to explain the gap fill theory, why prices often come back down to check the launch pad before going higher. And I am going to leave you with the final verdict on this historic week. The nightmare has hit the banks, but for you, the prepared investor, this is the moment you have been waiting for. Let's finish this. For silver investors, Sunday evening is usually quiet, but this Sunday will be the Super Bowl. At 6 p.m. Eastern Time, the GlobeX futures market opens. This is the first chance the world gets to vote on the Friday close. Here's the scenario. We are watching for the gap and go. If the panic is real, if the margin calls we discussed in part 2 are enforced, we will see the price open significantly higher than $67.42. It might open at $68. It might open at $68.50. This creates a gap on the chart, empty space where no trading occurred. Psychologically, this is powerful. It tells everyone that the asset is so valuable, nobody was willing to sell it at the old price. But here's the danger. Thin liquidity on Sunday night. Volume is low. It is easy to push the price around. Sometimes the banks will use this thin liquidity to engineer a fake drop. They might sell a few hundred contracts to make it look like the open is weak, trying to scare you before the real volume arrives on Monday morning. So here's your rule for Sunday night. Watch, but do not touch. Unless you are a professional futures trader, do not try to trade the Sunday open. The spreads are wide. The volatility is extreme. Let the banks fight it out. You wait for the dust to settle on Monday. Let's assume we gap up to $69 on Monday morning. You wake up, you check your phone, you see green, you feel a rush of adrenaline, FOMO, fear of missing out. Your finger hovers over the buy button. I have to get in before it goes to 100. Stop. Markets rarely go up in a straight line forever. There is a technical phenomenon called filling the gap. Often, after a massive jump, the price will drift back down to the level where it broke out. It comes back to test the breakout to make sure it is real. If you buy the panic spike at $69 and then the price drifts back to $60 to fill the gap, you're down $2 instantly. You feel stupid. You panic, sell, and then the price rips to $70. Do not chase the rocket. If you are already holding silver, enjoy the ride. If you are looking to buy more, wait for the retest. Wait for the price to come back and kiss the $67 level. If it holds there, that is your entry. Patience pays. Chasing gets you punished. We need to talk about the next target, $70. Why 70? Because it is a big round number. It is a psychological milestone. But more importantly, it represents the final capitulation of the bear case. Below $70, the skeptics can still argue that this is a correction. They can draw lines on a chart and say it is a double top. But if we break $70, the chart becomes vertical. The bear thesis is destroyed. This means that $70 will be a war zone. The banks will defend it with everything they have. They will place massive sell walls at $69.99. So expect turbulence as we approach $70. We might hit $69.50 and bounce off. We might chop around for a few days. This is normal. It is the market digesting the gains. Do not mistake a pause at $70 for a top. It is simply the market refueling before it breaks the sound barrier. Now, I have to play devil's advocate. I have to give you the downside scenario so you're protected. What if this is all a trap? What if the banks have one last trick up their sleeve? There is a scenario where they use the Sunday night illiquidity to stage a massive rug pull. They dump billions of paper contracts to drive the price back below $65. They want to break the spirit of the bulls. They want to trigger the stop losses of the people who bought the Friday high. If we see silver drop below $65 on Monday, that is a warning sign. It means the breakout might have been a fake out. It means we might need more time to consolidate. If this happens, do not panic. Remember the fundamentals. Remember Samsung. Remember China. A paper smash does not change the physical shortage. It just gives you a better price to accumulate. But you must be aware that volatility cuts both ways. If you're leveraged, if you're trading options or using margin, a rug pull can wipe you out. This is why I always say hold physical. Physical silver cannot be margin called. It sits in your safe. It ignores the rug pull. It waits for the truth to return. Let's zoom out one last time. Whether we gap up to $69 on Monday or pull back to $66, the verdict of this weekly candle is undeniable. We closed at the highs. We absorbed the selling. We broke the suppression. The trend has changed from down to up. The psychology has changed from fear to greed. The flow of metal has changed from west to east. You are holding an asset that is currently being repriced by the entire world simultaneously. This process is messy, it is violent, it is scary, but it is profitable. The banks are having a nightmare weekend. You should be having a great weekend. You did the work. You did the research. You bought the metal. Now let the market do the rest. So here's the plan for Monday. Watch the Sunday open. Look for the gap. Watch the Monday morning retest. Look for support at $67. Do not chase. Let the price come to you. Ignore the FUD. The media will try to scare you. Trust the chart. The nightmare scenario for the banks is the dream scenario for us. 6714 is just a mile marker. The destination is much further down the road. Stay sharp, stay stacked, and I will see you on the other side of the open.